Most people believe they understand money, but many of the financial rules we grew up hearing are simply wrong, and some of them quietly keep people stuck for decades. Number 7. Renting is wasted money. You've probably heard this your whole life. Stop renting. Buy a house. Otherwise, you're throwing money away. It sounds logical, it sounds responsible, but it's not always true. Owning a home comes with hidden costs most people rarely calculate. Property taxes rise, maintenance never stops, insurance premiums increase, and repairs can appear suddenly. A leaking roof, a broken air conditioner, or a plumbing issue that costs thousands overnight. Many homeowners underestimate how much money quietly flows out after the purchase. The mortgage payment is only the beginning. Over time, interest payments alone can equal the price of the home itself. Meanwhile, renters keep flexibility. They can move for better job opportunities, adjust to life changes, and avoid large repair expenses. They also have the option to invest the difference instead of locking money into one property. The real financial mistake isn't renting, it's buying a house too early, or buying one you can barely afford. And once people make that decision, they often believe the next financial myth that feels smart, but quietly makes managing money more complicated. Number 6. More accounts mean better control. Many financial influencers recommend opening multiple bank accounts for different purposes. One for bills, one for savings, one for emergencies, one for fun spending, and sometimes even more. It sounds organized, it feels like discipline. But in practice, it often creates friction. People start transferring money back and forth, checking balances constantly, and worrying about whether each account has enough funds. Small mistakes begin to happen. A payment gets missed, a transfer is delayed, or unnecessary fees start appearing because one account dropped below the required balance. Instead of feeling in control, people feel stressed. Financial stability usually comes from clarity, not complexity. One or two well-managed accounts with a clear plan often work better than 5 scattered accounts with constant movement. The goal is not to build a complicated system. The goal is to build consistent habits. And here's the interesting part. Many people focus so much on managing money perfectly that they become afraid of using powerful tools available to them. That fear leads directly to the next financial belief. One that sounds safe, but can quietly slow down long-term growth. Number 5. Debt is always dangerous. From childhood, many people hear the same warning. Stay away from debt. Debt will ruin your life. It sounds protective, it sounds wise, but it oversimplifies reality. Debt itself is not the problem. Misused debt is. Credit cards used for impulse shopping, expensive gadgets, or lifestyle upgrades can create financial pressure quickly. Interest piles up, payments become stressful, and people feel trapped. But other forms of debt can open doors. Student loans can lead to higher income potential. Business loans can help entrepreneurs expand operations. Mortgages can allow families to build long-term stability. Even large companies rely heavily on debt to grow faster. Without borrowing, many successful businesses would never exist. The key difference is purpose. Debt used to create value can strengthen financial position. Debt used for consumption usually weakens it. Avoiding all debt may feel safe in the short term, but it can also prevent people from taking calculated risks that build wealth over time. And surprisingly, the next financial belief is even more dangerous, because it convinces people they are saving money, while inflation quietly erodes their future. Number 4. Saving money guarantees wealth. Most people believe that if they just save enough money, they will eventually become financially secure. It feels responsible. It feels safe. But saving alone does not create wealth. In fact, money sitting in a regular savings account slowly loses value every single year. Not because of bad decisions, but because of inflation. Prices rise quietly while your savings grow very slowly. Over time, the purchasing power of that money shrinks. 10 years ago, a certain amount of money could buy much more than it can today. That difference is not always obvious in the moment, but it becomes very clear over decades. Saving is important, but saving without investing is like running on a treadmill. You are moving, but not getting ahead. Wealth usually comes from making money grow, not just protecting it. That means learning about investments, assets, and long-term growth, instead of relying only on savings. And here's the uncomfortable truth. Many people who believe they are being financially careful are actually falling behind. Because the next belief sounds extremely responsible, yet it quietly traps people in a cycle of constant stress. Number 3. A stable job is security. For decades, people were taught that the safest path in life was simple. Get a stable job, work hard, and stay loyal to the company. That idea used to make sense. But the world has changed. Companies restructure, industries evolve, technology replaces roles faster than ever before. Even strong businesses make sudden cuts during economic downturns. Job security today is often temporary, not permanent. Many employees believe their paycheck equals safety, but a single source of income is actually a single point of risk. If that income stops, everything else becomes vulnerable: rent, bills, savings, and future plans. This is why layoffs often feel so shocking. People assume stability until it disappears overnight. True financial security usually comes from flexibility, skills, and multiple income streams, not just one employer. The safest worker today is not the most loyal one. It is the most adaptable one. And that realization leads directly to another belief that sounds motivating, but quietly pushes people to make some of their worst financial decisions. Number 2. Working hard always pays off. This is one of the most powerful ideas people grow up believing. Work harder, put in more hours, stay busy, and success will eventually follow. Sometimes that happens, but not always. Hard work alone does not guarantee financial progress. Many people work extremely long hours for years and still struggle financially. Others work fewer hours but focus on high-value skills, smart decisions, and opportunities. And they move ahead much faster. Income is often tied to value, not effort. A person digging holes all day may work harder physically than a software developer or business owner. Yet the developer or owner earns more because their work solves bigger problems or serves more people. This truth can feel uncomfortable, but it explains why effort without direction often leads to frustration. Financial growth usually comes from strategy, learning, and positioning, not just endurance. And the final belief on this list is the most dangerous of all, because it quietly convinces people they are being responsible while their financial future slowly slips away. Number 1. Budgeting alone creates wealth. This is the financial belief that feels the most responsible. Track your expenses, cut unnecessary spending, stick to a budget, and eventually you will become wealthy. Budgeting is important, but budgeting alone does not build wealth. Many people become extremely skilled at saving small amounts of money. They compare prices, avoid luxuries, and carefully control every expense. Yet after years of discipline, their financial situation looks almost the same. Not because they failed, but because they focused only on controlling money, not growing it. You can only cut expenses so far, but income and investments can grow without limits. Wealth usually comes from expanding earning power, building assets, and making money work in the background, even while you sleep. Businesses, investments, and valuable skills create momentum that budgeting alone cannot provide. The goal of budgeting is not to stay small, it is to create space for growth. Because in the end, financial success is rarely about how tightly you hold money. It is about how wisely you make it multiply.